All right, so my next guest has been spot on in so many aspects of the market, but things are moving fast, so let's get an update. I want to bring in UBS Private Wealth Management Managing Director, Alli McCartney. And let's start, Alli, with some of your June targets, all right?
June targets.
You don't just say one year from now. You're
Yeah.
slicing and dicing. All right, 7,300, you feel pretty good about that for the S&P, right?
We do feel pretty good. I mean, I think there's upside for sure.
Now, the 10-year yield, this is kind of bold. It's like
We've not been right there.
I mean, it gets down to 4 and it gets smacked up. And listen, I remember a couple of years ago talking to Grant saying, listen, the secular bull market was over and these secular bear markets can last 20, 30, 40 years. And maybe it's a new reality. We don't get under 4.
It's fair. I think the issue is, are we between 4 and 5? We have problems if we're over 5. And then we have problems if we have to forcefully cut under, because that means that the labor market or geopolitics has gone wrong. So as long as we continue to have some interest rate volatility, it's probably around things like foreign interest in buyership of U.S. Treasuries,
Right.
makeup of the Fed,
Right.
you name it.
But the fact of the matter is the yield has been steady. It just hasn't gone under 4.
Exactly.
Gold, you've been pounding the table on gold, give you props, but you're past your target. So what, can we get a new target?
Well, so the way that we always do it is we have sort of base case upside and downside. Our upside scenario to gold, which by the way is not necessarily an upside scenario to the world, is 5,400.
Okay, so I'm going to pencil that in, 5,400.
I think that is a likely target.
Yeah. I mean, listen, last week, I think it was Goldman went to 5,400. This morning, SocGen said 6,000.
There are so many tailwinds to gold, whether it's geopolitics, local politics, anti-American sentiment, waning U.S. dollar. I mean, it's hard to imagine it keeps up its current pace, but it's hard to imagine it doesn't both provide ballast in a portfolio and future upside.
Talking about earnings season, right? It really, really takes off this week. Now, here's an interesting thing. Fourth quarter, Mag 7 was up 20%, right? And now they're looking for this year to be up almost 23%. Momentum. Here's what's interesting, though. Fourth quarter, the rest of the market was only up 4%. So this 12%, I think everyone's banking on this really making this rotation stick.
Yeah. So I think we definitely have a broadening out of the market. We've seen it already, and there are a whole host of reasons we believe it's going to continue. Don't know. Because of this, and because of the prevalence and importance of the names reporting this week, whether that is going to be a theme for this trading week. But I think for the earnings season and for the quarter, it will be.
Yeah, I mean, it's just, to me, this is a bigger question mark. I have faith that the Mag 7 will deliver. It's just that it's been a while for the 493.
Yeah, but let's talk about the 493. So that difference was much different in prior years. There was, 2 years ago, it was like 50% and negative 4%.
Right.
So this is
it's trending
a
in the right
broadening.
direction.
And all of the tailwinds that we have, whether it's decreasing interest rates, whether it's money in the big, beautiful bill that either comes into households as checks or decrease in withdrawals, that money, oftentimes about 50 cents of that goes into the market, so consumer discretionaries, you name it. So that's where I think you're going to get a big bang from that.
And you might, so we'll see, maybe see more in the second half. Attractive sectors, IT, utilities, healthcare, financials, but you really like global banks. How does someone play? Is there an ETF for that?
Yeah, so there are a lot of ways to do it. You can buy the names, or you can buy the big banks via the KBW ETF. But we think that there should be big global banks, and as I know you and Eric and Nigerian talk about a lot, there should also be some regionals, because, I mean, the tailwinds, whether you talk about regulatory, increase in investment banking, decrease in regulation, increase in net interest income, they're high and they're going higher.
So you're confident, but you do have some potential. You want to share the risk, right? AI spending declines. Right now, it doesn't look like we're going to come anywhere.
Hard to imagine.
Global tensions. This is a tough one because, I mean, at any given moment, we get a flare up somewhere. A guest earlier talked about an armada going to Iran, and that's not even moving anything, right? Years ago, we'd be on pins and needles. So I'm not even sure what qualifies as global tensions these days.
Well, it's here to stay. We're not moving backwards in this. In a way, you could see it. Think about a year ago today when we were just ahead of tariff day and what that did to markets versus what Davos and Greenland did to markets. A month versus a day. We understand how this president works, that he negotiates in public. and that there's a lot of forthrightness. But going forward, there's going to be a lot more volatility, which is why you need the broadening, you need the diversification. And even though we see a lot of support in large cap US equities, especially those sort of 10 in the big AI trade, you have to be diversified because of that.
15 seconds. The Fed cuts too much.
Yeah.
Apparently, I mean, that would be like an SOS, I guess, for the economy if they really had to cut a lot.
It means that growth isn't materializing like we think it's going to be. It means there's stress in the labor market. It means something potentially about the composition of the Fed or people's trust in the institution has changed. None of those things will be good for the market.
So good seeing you, my friend.
You too.
Happy New Year.
You too.
Always.